Hello my fellow freedom builders and welcome back to the channel. Today we're going to have a chat about something called trend following. As you know, I'm here to try and give you some tools and instruments so that you can build a good solid financial future. And to do that we want to at least do as well as the stock market or maybe even beat the stock market. And as you know, I have been talking about some automated strategies, and today we're going to talk about one of them. Or it's actually not one strategy, so I'm not going to give you specific strategy criteria today. I'm going to talk about more of a philosophy or an approach to the market. Because what I do when I look at my charts, and I hope that you have seen that if you have watched some of my videos, is that I am a trend follower. That means that I start to invest in a stock when it has started trending. That means I never get in at the bottom and I never get out at the top, because I only get out of the stock when it starts to top out, when it starts to drop and the trend is reversed. And that is my basis approach. Now, is that really so hard, you might ask? And no. At least it is quite simple. That doesn't necessarily make it easy, but it is simple, because all I need to do is find trending instruments. It could be a stock or an ETF. And then I jump on the train and I ride it until the trend starts to change. Now, is it really hard? Yes, it can be. Because as I'm going to show you, we might get into stock, or at least our trend scanner might give us some stocks that has already gotten up 50 or 100 or 150%. And now what we have learned back from when we were in school is that if you are a good businessman, you buy cheap and you sell expensive. But what we do here is actually that we buy expensive and sell even more expensive. So what we need here, and I hope you follow me right to the end, because I'm going to give you some very good links and some good tips as to how to approach this strategy. Because what you need here is actually you need to put your ego aside. Because what we like, or at least what most investors like when they invest, is they like the feeling of being clever. They like the feeling of saying to the neighbor or the colleague or their wife or their husband and saying, yes, I picked XYZ stock and it went up 100%, see how clever I am. But that is not the point at all. I found this chart a while back and it actually says it all. We can see here that years spent trading and the amount of ego needed, because what many years in the market does is that it humbles you. It makes you, or hopefully it makes you aware that actually it has nothing to do with you. If you pick the right strategy and you control your risk and you just start investing, then you are pretty far better off than many investors that try day in and day out to try to outsmart the market and say, I know that this company comes up with a new revolutionizing technology. Well, maybe that is already priced into the market. Maybe you should just pick the stocks where all the big players are already jumping on board, because that is what moves the trend. So what we need is we need to get rid of that ego and just acknowledge that every time we have a big winner, well, that is because we have a strategy. And every time we have a loser, we can also say to ourselves, well, that wasn't me, that was just a strategy. So what do we have of evidence that this actually works? Well, I can tell you that where I first found this approach described in details is at a website called trendfollowing.com. I'll show it in a second. It is run by a guy called Michael Covell, I think it is pronounced Covell, and he has written some very good book. The first book I got my hands on was the Trend Following book, and I also read the Complete Turtle Trader and several of his other books. Now, what he started to do is he started to interviewing trend followers, because this trend following phenomenon interested him, and he started to interviewing all of the big trend followers. And believe me, there are some huge trend followers out there. What I'm often met with when I start to talk about graphs and charts is that, oh yeah, well, show me the rich technical analysis, because people know that we have Warren Buffett and Bill Gates and so on, and they have invested in fundamentals in companies. So people say, yeah, well, why aren't there any rich technical analysts? And believe me, there are. There are several billionaires that has only done this. Billionaires in US dollars, that is. So this is where I started my journey. And at this website, we can just have a quick look. Here it is, thetrendfollowing.com. Here we can see all of his book, and on this website I started to read along with the books. And one of the funny stories I learned was that this Turtle Trader project, I'll do an entire video about that later on, but basically that is the story of a very rich commodity trader in I think it was Chicago, that was called Richard Dennis, and he set out on an endeavor to show that you could actually just teach ordinary people how to trade everything, and they could be quite as successful as he has been, or he had been. He's dead now, but he had made several million, $100 million in commodity trading, and what he did was trend following. Not many people called it that at the time, but what he did was he had a very specific rules-based system that told him when something was trending, and if it was trending up, he went long. If it was trending down, he went short, and he did it across all markets. And that is the entire book here describes that, and I really recommend that you read that one, The Complete Turtle Trader. Here we can see him, Richard Dennis, and what he did was that he put a little ad in the newspaper saying that he was accepting applications for the position of commodity futures traders and no experience was needed. And then the story goes on, and several of these turtles, as he called them, went on to become multi-millionaires simply by following a trend following system. So it is possible. The picture here, you might know the movie Trading Places, and I'm actually not even sure if Richard Dennis was inspired by the movie Trading Places or if Trading Places was inspired by Richard Dennis's experiment here. But it looks very much alike. He set out to show that just take an ordinary human being, teach him the right rules, put him in the right surroundings, or her, and then he or she can succeed. So that is pretty much what it is all about. Now, is there any historical evidence that this worked? Oh yes, there is. Well, first of all, on his website, on the trend following website, there are several examples of trend following funds that has been running for several decades. One of the things I also hear very often is, yeah, well, this graph or chart investing, that is very fine, but you have only been doing it for a few years, 5 years, 10 years, or 15 years, so we cannot be sure that it works under all market conditions. Well, one of the most well-known in this niche here is Bill Dunn. He has the Dunn, I don't recall what it's called. He has an investment fund only working after the trend following principles. And as you can see, it started back in the 70s here, and he has been outperforming the S&P 500 significantly. As you can see, $1,000 put into action back here in the 70s. Having put it in the S&P 500, it would have yielded, you would be at $151,000, and having been using trend following, you would be up at above $1 million. As you can see, the Dunn composite here, 16.5%, the S&P 500 just below 12%. So it might not seem as a big difference, but if you've seen my video about compound interest, you know that this can make a huge difference. The thing about trend following is that it also has some huge drawdowns, and that is an important factor to consider when you are talking about how something has performed. Because what are the drawdowns? What is the volatility? And as you can see, this Dunn composite here has significantly more large drawdowns than the S&P 500, and 63%, 28, 27, 30, whereas the S&P 500 only had 51 here, and then we've had some 35% here at the beginning of 2020. So, but of course you could say this is just one man with one company. Yes, but there is some very good research on the website as well. And one of them is what is called a century of evidence on trend following investing. And it is made, I don't recall the university actually, but it is some highly esteemed people that have done the research. I've put the link so you can read it all by yourself. But what they actually did was that they took a look at 67 different markets. And that was 29 commodities markets. That could be gold, silver, oil, but also it could be some frozen orange juice, it could be meat, it could be all sorts of commodities. There were some equity indices, there were some bond markets, and there were currency pairs. And then they took their performance on a 1, 3 and 12 month time series and averaged it out and saw which of these have performed positively over these 3 time spans combined and which have performed negatively. If they had performed positively, they went long in the commodity or the currency or whatever. And if it had performed negatively, they went short. So what they basically did is that the instruments that had already gone up, they bought in, they went long. The instrument that had gone down prior to the current date, they went short. And they did that on, I don't recall if it was once every month or every 3 months, but that was rebalanced on a regular basis. And they back tested this back from 1880. So, and then up to 2013 here. So that is, what is that, 133 years? Is that enough data for you? I think it should be, and it is over 67 markets. Now I know that some of these markets were not there in 1880, and they describe in detail how they adjust for that and how they simulate some of the data. But what is really interesting here, and we can try to zoom in a bit, is, let's just have it here, that the performance, the average yearly performance from 1880 to 2013 was almost 15% per year. Now, I don't recall they haven't put the S&P 500 in here actually, but that is somewhere around 7 to 8, maybe 8.5%. So this is roughly double the performance of the S&P 500. Then I know there are trading costs and all sorts of stuff, but as you can see, strategy performance after simulated transaction costs. So they have deducted transaction costs. And in this one, the second column here, they have also deducted some fees, 2% administration fees and 20% performance fees to simulate if this was some sort of fund that did this for you and you hadn't had to lift a finger to do all of this. So that means that it went down from 14.9% to 11.2%, but that is still way above what S&P 500 has done in the same period. I know that S&P 500 hasn't been around since, was it, I don't recall the year actually, somewhere in 1950, 60, something like that. But it is simulated, and some of the markets have not been included in the first time periods. What is also interesting is that just following the strategy where you go long the stocks that has gone up, you go short the stocks that has gone down, or the indices or the commodities, every single time period here, every single time span from 1880 to 89, 9.1% per year. From 1890 to 1899, 14% per year, and so on and so forth, up until 2013. They took 13 years in the last year, where it has made 11.3%. Then I know from my own experience that there has been some years, 14, 15, 16, that was a bit rough on the trend following, but that doesn't matter, because then we get a big crash, for instance. We have one in 08 here, but we had a crash in 2018, in the Q4 in 18. We had one here in 2020. And these volatile time periods is where the trend followers are really making money, especially when they also go short when the market drops. You can't see the realized volatility here. That is actually not extremely high. you can see the Sharpe ratio net of fees. And if you, I don't know if you know that, but the Sharpe ratio is your performance divided by the average volatility, and then you get some sort of risk adjusted performance rate here. And as you can see, in a lot of these years, we are up around 1. And to have a Sharpe ratio of somewhere between, at least above 0.5 is actually amazing. But when we get up around 1, people tend to get really, really happy. And most fund managers would give their right arm for a Sharpe ratio every single year above 1. So that is very, very amazing. Another little fact here that is interesting is how the trend following strategy or philosophy has done during some big crises. And here they have taken all of the huge crises back to the 1893 here. We have one in beginning of 1900. We have one here in 1617. We have the big crash, the big Great Depression. We have the recession, stagflation, oil crisis, the 87 crash, and so on and so forth. And as you can see, the blue here, that is not the S&P 500. It is a mix of 60% stocks, meaning 60% S&P 500 basically, and 40% bonds. And that is one of the, what you could say is normally mentioned as a rather conservative approach to go for this. And as you can see, the trend following philosophy and strategy has outperformed. They have done great in every single crisis over time for the last 130 years. As you can see here, they actually did great in the financial crisis, again, because they were allowed to go short. So in this paper, there is a lot of numbers here, and there are some how long the different drawdowns took and so on. You can read it for yourself. As I said, I will link to it below. But there is a huge theoretical body of evidence that shows that trend following is not just a little gimmick, a little trick that some online guru is trying to sell you. This is actually the real deal. This is something that can outperform the market. However, none of you, of course, or at least not many of you, are sitting with the possibilities of investing or trading in 67 different markets, and many of you would not be able to stomach the drawdowns that is also included here. But what I'm saying here is that trend following works. This is what I do on a day-to-day basis. What I try to tell people, let's say I find a stock that I say, this one I think is going up because it has already started going up. And then it goes up 100%, and people start saying to me, wow, that was amazing, Hans. And I said, well, it was great. It was nice on the account, but it was not really amazing because I didn't know if it was going up or it was going down after I bought it. I simply just controlled my risk. I knew exactly what I could lose if it went the other way. I knew exactly when to get out of the stock, and then I just started looking for a new one. And that is basically all about putting your ego aside and saying, this is not really me. I'm just following the big guys that are putting money into something. All right, let me give you a quick example before we stop here. Just a second. All right, here we have a stock on a weekly chart. I'm not telling you which stock it is, so I have deleted the name of the stock. But we have found out with some sort of trend following strategies that back here in 2012, it has started to make higher highs on a weekly chart here. Now, at this point, it was at 57 in this currency. It is a European stock. So it is 57 of whatever currency that is. Now, you might want to say from a bottom here and up until here, it is actually already up 150%. And at this point, some analysts said, now it is way too expensive compared to what it's earning and so on and so forth. All the big analysis thought with big egos saying, I know where this stock is going and it is definitely not going up. Well, we could get a buy signal here around 57 and we could say, I just hope it's going up, but if it doesn't, we might put a stop loss down here somewhere and then we will get out and find a new stock. So let's have a look at how this stock turned out. And you can see I'm going forward here 1 week at a time. In a very short time period, it went up to, what do we have here? 83, 97, it dropped down. And as you can see, now we can adjust a bit here. It kept going up and up and up, and all of a sudden it was in 160. And some people might have said here around 100 and said, nah, it has already gone up a lot, so I think it's getting too expensive here. But the trend follower would say, are you sure? And he or she, the trend follower, would stay in the stock as long as their stop loss were not hit, and as long as they didn't start to make new lower lows, because then we knew the trend was over. Maybe the trend follower would have gone out here at 191 and said that was a nice profit. But then all of a sudden, as we can see, we started to make new higher highs, and the trend follower says, well, I don't care, because sometimes you get tricked into emotions and saying, yeah, well, I have been in, I made my money here, I don't think it can go up anymore. But the trend follower doesn't care, because the trend follower is not bound by his or her ego. So at 274 maybe, the trend follower enters again and saying, oh wow, that was a nice profit, and we have to adjust the chart once again because the price is going up so much. And there is a bit of a wiggle here, and then it starts to go up again, and we can speed it up, we can adjust the chart here. And as you can see, sometimes you might get tricked out, but the trend follower keeps going in every time a new trend pops up. And then all of a sudden, we start to get indications of a trend that is broken. And the trend might drop. We don't know. Who knows? We just follow the trend. So as you can see, if we down at 80 or 90 would have said, this is too expensive, we could never have taken it up to 1500. To those of you from Denmark, I don't know how many of you are here. The stock is a stock company called Genmap, and it has actually done extremely well, and the trend follower would have been in here. So you would think I was in, but actually I was not. I was saying to my subscribers that this was a great stock here around 1800. I didn't get in myself for several reasons, and that really annoys me. So is it too late now? Well, some of you would say 2,300 Danish kroner, that is around what, $400 something. That is quite expensive now, looking at the numbers and so on and so forth. Well, the trend follower really shouldn't care and just enter. That is the basis, that is the essence of trend following. You should put your ego aside, you should put your emotions aside and just say, is the trend up? Then I'm buying. Is the trend down? Then I'm selling. You could take another example, and we can look at another Scandinavian stock here, where in this crisis in 2020 we could have made a lot of money actually since 2019. This is an airline company, and we could have gotten a short signal somewhere here, and we could have made a ton of money. We were getting a short signal again here, and we could have made a ton of money. So if you have an approach where you can both go long and short, you're pretty well hedged towards a big crisis, because you will already be short in some of the stocks that are then even dropping faster when the market is in some sort of crisis or crash. So when I'm talking about trend following in my day-to-day strategy, and some of you are asking me, well, you just entered this stock, let's just take one of them. For instance, I just entered Tesla, as you know, and as you can see here, Tesla is in a trend, so I was allowed to enter. If you've seen my other videos, you know that I have several trend criteria, so you can put all sorts of criteria down, just as long as you have a fixed strategy that you have been able to test way back. So I'm long Tesla, and people are asking me, what is your target? How far do you think this can go? Well, I think you have guessed my answer by now, because what I say to people is, I don't have a clue. I don't have a clue if it'll go to 1,000 tomorrow and I might get tricked out, or if it'll go to 10,000. Who am I to say? I'm not an expert, not on Tesla, not on electrical vehicles, not on anything pretty much on the stock market. I just know how to spot a trend. And that is how I make a living. So if you follow my videos, and I have the playlist that is called something like Learn My Strategy. All my strategies, all the criteria for entering and exiting a stock is mentioned in there. There are no secrets. I'm not selling you anything here, but this is actually a fairly simple principle, and you don't have to be educated in a bank or anything else. You simply just need to be able to look at a chart, to follow your rules, and to decouple your emotions and your ego and just saying, I'm going with the flow. That's basically what this is. And I know it sounds easy, and it is easy to sit and look at a chart like this and saying, yeah, I would have gone in here around 700 and I would be rich now. But it is hard. And in this spring, many of you, my subscribers, know that I started to buy stocks when I was 100% certain that the market would tank. Back in the end of March, when everybody said, me including, that the market would at least go down 20 or 30% extra, I started to get buy signals. There started to be stocks that were in an uptrend, so I started buying, and it was extremely hard. And I think it was only because I have a lot of subscribers that expected of me that I followed my own rules, that I actually got in, because it was extremely hard buying up in a market that you were certain were going to go down. But what happened? Well, who am I to argue with the market? Everything went up, and you can argue if it was the Fed or a V-shaped recovery or whatever. Doesn't really matter. The market went up, so I started buying. That means that I have been doing quite well this year, outperforming the markets I'm comparing myself to, even though I was convinced it was going the other way. So that is the strength here. And I really recommend that you start to read something about trend following, you start to test your own strategy, or you start to apply mine or some variation of mine. You don't need to copy me, but you can just get some inspiration here. So I hope this was some sort of inspiration and some sort of insight into what trend following is. It is pretty much all I do. I combine with a bit of fundamental analysis, as you know, and that is because that when I scan for my trend candidates, then I get maybe in the US market 50 different candidates or 70 different candidates, and then I choose the candidates because I often have the companies for quite a while, some month or maybe a year or a year and a half if the trend continues. So why not pick the stocks that in a good trend that also have sound fundamentals? So that is kind of it. You could argue that the Tesla fundamentals might not be as solid, but that is an entirely different story. So I hope this gave you something of worth. If you think it was worth your time, please consider hitting that subscribe button down there, the like button, all of the buttons you can find down there. I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.